Good afternoon, everybody. Welcome to your Monday edition of the TraderMerlin Show. My name is Merlin, of course. And yes, I am a 49ers fan with really bad hairdo today. I hope you had a great weekend, did something fun, and enjoyed some of the heat and sunshine. I'm out here in sunny California, so for those of you who are, I got Sid from Kansas City. We also got California, of course, from California. Les in Cape Canaveral. It's funny, we actually saw a rocket launch from Vandenberg Air Force Base during the middle of the Smokey Robinson concert the other night. That was pretty cool. Anyway, hello everybody. Futures Trader, Joaquim, Ricardo, Lisa, Ivan, and Liz, and the rest that will be joining here shortly. I wanted to take a chance to, I wasn't actually going to title the show a specific viewer's name because he sent in a bunch of questions, but then I had a lot of other questions, so I thought, you know what? Let's just do an open Q&A show, which we've done in the past. I try to do 1 or 2 a month just to catch up because I fall behind. But this is our 24th of July session, and we'll dive right into those listener questions. I wanted to get them all done, and then I'll go into our overall markets. We can talk about earnings. We can talk about the FOMC. You guys can belittle me for my article I wrote for Bar Chart. So some of you may have read that one. So let's talk about the rebalancing of the Nasdaq 100. Here's a question from Les. This question about the rebalancing of the Nasdaq 100. Will the price of the triple Qs not be affected by it, whereas the price of an individual stock like Microsoft will be? When will we see the efforts of these rebalancing? Well, it's done. It is fully rebalanced now, and the allocations have changed. So I know that some of you are wondering what those allocations were. I should have taken a screenshot of the statistics beforehand and afterwards, but luckily people do that for me, so I got this one here. Here's the Nasdaq 100 weightings. You can see what they did is they took a snapshot of July 3rd's weighting, and it's kind of interesting that that was the cutoff date because Facebook or Meta had a nice rally after July 3rd, and that was an interesting one because they actually should have had their weightings reduced, but because it rallied as much as it did, it missed the cutoff here because, anyway, it was July 3rd. It wasn't as highly valued. It wasn't in the top 10, so it didn't get hit. Here's the number one. You had Microsoft, 12.8%. It was the number one component of the Nasdaq 100 as of July 3rd, and actually as of probably last week sometime. Now it's about 10%. It's actually just slightly below that. I pulled up the weightings on a different site. It's just under 10% now. Apple was 12.45. That's showing 9.97. You had Google, and again, this is, you see here it says GOOG and GOOGL. What they've done here is they've combined the two because there's GOOG and GOGL, but they've, whatever, for whoever did this, labeled them as one, that's fine. That got reduced from 7.3 to 5.7, so a slight drop there. NVIDIA got cut, Amazon got cut, and Tesla got cut as well. And you can see that those 1, 2, 3, 4, 5, 6, 7 made up at the time on July 3rd about 50, call it 51% of the NASDAQ. They've now been cut to 40%. So that's a little bit of a trimming there, which shouldn't have too big of an impact. Now, the question from Les, which was, does it impact the price of the QQQs? No, because what they'll do is they're just going to, they'll take a snapshot, they'll sell off the ones that are overweighted and calculate those down, but they're also going to increase the weightings of some other ones, like Meta would get a little bump here. And what I didn't see was which ones actually got the increase up. Was it an overall increase, like all the components? And that I don't know, but I do know that those major ones, like the big leaders there, got cut, Microsoft and Apple. And if you look at what happened last week, you know, there certainly was a lot of activity in some of these. Here's Meta. Let's go to Microsoft. Right, so Microsoft had a fairly volatile week last week, going from 345 all the way up to a high of right around 366, and then falling back down to a low of looks to be right around 339. So big volatility last week. Of course, if you look at July 3rd, which is right where my cursor is right here, that's when they took this snapshot. So it was interesting to me that there was actually a run-up going into this because that was almost guaranteed that Microsoft was going to get trimmed as well as Apple. Here's Apple's price chart for you. Not really a lot of action last week or even today, down actually just up ever so slightly today, but not that big of a deal with regards to Apple, which was, you know, your second biggest haircut. Now we go out to look at Google. Right, Google last week had that big swing, a lot of fluctuations, but overall not really having an impact on that triple Q price. We had the same basic action for the triple Qs that we did for Microsoft, and actually Microsoft really mirrored the triple Qs more. But the damage is done. Those weightings have now been updated, and I think for me, it actually, if you look at this as an argument of is this bullish or bearish for technology, you guys let me know what you think. Do you think that this rebalancing is actually bullish for the triple Qs or bearish for the triple Qs? I'll let you think about that and type it in the chat here because I'm curious what you guys think. For me, if I step back and look at the reason why they did this, he had 55% really in the top 7 companies. That is heavily overweighted. And I personally think that 40 is too overweighted. It should be somewhere down around 30, maybe even less than that, since you have 100 different companies in there. But what they've done is the ones that have pulled this market up the most, which are going to be Apple and Microsoft, because that's why you've seen them move to the top of that list, is that price just keeps rallying and rallying and rallying. You've basically hedged risk here, in my opinion, by reducing your exposure to the most volatile components in your portfolio. So I actually think long term it's going to be bullish, unless you believe that Apple and Microsoft are going to continue to lead and have huge market rallies. But when you look at something like the Strategic Investor course, which personally is my favorite course at OTA, is they'll look at things from the perspective of you start off January 1st with a portfolio. And let's say I've got 4 different positions and I have 25% allocated to each one. You assign whatever you want to those positions, gold, silver, it doesn't matter. Bottom line is I got 4 different positions and my mindset is I want them equally weighted. Over the course of that year, one of those rallies significantly. Another one falls significantly. So let's say at the end of the year, I get to December 31st, I look at my portfolio and I no longer have 25, 25, 25, 25. Let's say I've got 40, 25, 30, 40, 25, 20. So now I'm at 85 and at 15. Well, what I need to do is I need to sell some of the 40 because it's done tremendously well. And the general thinking is you should ride your winners, but also knowing that markets are cyclical. There will be patterns and they'll start to, the bad ones usually perform well and the good ones perform poorly. So I need to do is sell some of that 40% position in my portfolio to get it back down to 25. And I need to buy some more of the 15 to get it back up to 25 and rebalance that portfolio. And that's really what they've done here for the Nasdaq 100. In the long term, it's better overall for the index because in theory, some of the ones that got a higher weighting now are going to start to perform better because they've been underperforming Apple and Microsoft. So just the basic principles of portfolio rebalancing. Let's see. Liz says, neither bullish nor bearish since the price of the QQQ isn't affected overall. True, but the weighting of the magnitude, the pull of that index, right? So the factors that are driving that Nasdaq 100 have changed, and it really was these Magnificent Seven, which is the names you see on your screen here: Apple, Microsoft, Alphabet, Nvidia, Amazon, Tesla, and Meta. Those are the ones really driving it, and so they've now cut that exposure. So if there is a pullback in these, the damage won't be as good. And again, I think long term, that's probably more bullish than it would be bearish for the overall market. And I don't mean it like, holy cow, load the boat on the triple Qs. It's just, again, from the long term perspective, it's the right thing to do. It's pretty good. Let's see, Tom says, those top 7 were propped up by funds that have to have them so the value of QQQ may be a little less volatile. Correct. I think you'll remove some of the volatility, but again, remember some of those funds that were required to hold Microsoft and Apple because of tracking of indexes now have to lighten up those a little bit, and that's why I thought we would see more selling over the past week, which we really didn't. There wasn't a tremendous amount of selling. So all in all, that rebalancing is done. I think it's best for the stability of the Nasdaq, which has been on an absolute just screamer of a run. I'll bring up the Nasdaq 100. There you go. Barring that big sell-off we had last Thursday, today I actually took a little bit of a loss on a short trade. You guys know I had my number here on the triple Qs. My number was, apparently it didn't stick on this chart, but my number was right below the low of Friday's session, which happened right in the early morning, which was 375.19. As soon as we broke down below 375.19, took a short trade. Actually had a pretty good size short on this one, and it just came right back up. I'll show you the intraday time frame here, because one of those ones you just go, hey, follow my rules. Yeah, there you go. So as this thing, the opening 15 minutes were rather quiet, gapped up and kind of hung there. We'll talk about gaps here in a little bit. And then ultimately started to scream back down, and I got in short right as we broke down below this. So actually at one point it was a nice winner. Ended up taking a few $100 loss on it, but it's okay. I still personally think that weekly shooting star formation we have, that's the daily, excuse me real quick. I still think that this weekly shooting star formation is still in play. Even though we tiptoed it below it today, I'm still going to play it as if it's still there. So if I get an open up above 375.19 tomorrow and I get that short down below it, I will be making the same trade and hopefully adding more to my position and capitalizing on a downward move, which I do think is coming. The tricky part is all the announcements happening tomorrow. We'll get to that here right after we run through our questions and get to over markets. All right, what does Joe say? We should take a look at our S&P end of year forecast at some point. Well, we did. No, there's no updating. No. You can't update your forecast. You got to leave that forecast there. It's carved in stone. This is blockchain data here. You can't go back and edit that. Yeah, we did that at the end of June. We did the 6-month review of that one, and maybe we'll do that one down the road a little bit. But yeah, some people getting closer. Funny, those of you who are like, we're way off at the beginning and now all of a sudden it looks good. You're like, hey, can we review that? I want to get my name on the screen there. No do-over, Lisa. No. Can't I mean, we could make a separate column. That's maybe what we could do is we could add a separate column and say the revised forecast. We could be real analysts, right? All you have to do is you upgrade your forecast every month, or whenever you're completely wrong, you just update your forecast. And then if you're wrong on the second forecast, you can always bounce back to your first one and go, see, I was right there. The beauty of being an analyst. Okay, let me see what we got here. So this is from Jeff. Jeff, thank you for the question. Sending a whole bunch of them. He says, I have an account at Vanguard for my last job. Of course, the offerings from the program I was in seem limited and doesn't allow for stop limits or options plays. I'm thinking about moving it to another broker. Currently, I use TradeStation, TD Ameritrade, but I was thinking about opening an account with another broker for this portfolio. Can you suggest another broker you've used that has a nice platform? What is the amount of protection by the FDIC for retirement accounts? Typically, FDIC doesn't do anything with retirement or investment accounts. FDIC is only for cash deposits, and that's $250,000. I believe that SIPC insurance right now is still at $500,000 for your portfolio. As far as platform, I guess you have to look at what you want to use, what you want to do. So I have accounts at TD Ameritrade, so I got an Ameritrade account. I have an E-Trade account. I have a Schwab account. I have a TradeStation account. I have accounts all over the place. And each one of them brings different things to the table. Now, judging by your comment here, you said, I have an account at Vanguard from my last job. So now I'm already thinking that's a 401k plan that you're going to roll over into an IRA program and be looking for the tools and functionality there. So this is not active trading. This is more simple. I want to place trades once a month or once a week. And I'm assuming that's what it is. And of course, we know what assuming does. Makes an ass out of you and me, as they say. But I think any one of those is fine. If you know you're going to be doing one thing particularly and doing it a lot, like options, then you might want a more option-specific program. So you could be using something like, Thinkorswim, which is through TD Ameritrade. But that, to me, you kind of have to know your options platform very well to be using TD Ameritrade. That's not a user entry-level platform. If it's just casual investing, E-Trade's fine, Ameritrade's fine. Schwab's okay. I don't like their options entry at all. I think it's clunky. But I have multiple accounts at E-Trade and Ameritrade, and those work fine. And we'll get to your second part of the question here, which deals with, let me see if I can actually find that second one right now, which is, here it is. Second part of Jeff's question is it possible to open up several accounts at TD? I like the Thinkorswim platform, but would like to have an account I just traded options with, another for long shots and so on. Yes, absolutely. I have multiple accounts at those brokers. I have multiple accounts at TD Ameritrade, and I label them. This is the 1% account. This is my risk account. This is options account. This is, I'm marking them all up so I know when I trade in that account, I specifically have guidelines and rules for that account. So yes, you can have multiple accounts in under one account login. So easy to do on any platform. So yeah, I have 4 accounts at E-Trade, and I have 3 accounts at TD Ameritrade. I only have 1 at Charles Schwab. I may actually be closing the Charles Schwab one just because I don't really use it that much. Kind of a small account for me. Let's see. What do we got here? Day trader talk. My day-to-day, my level came in on Bitcoin, shorted Bitcoin futures. So you're doing futures, perpetual futures, day trader? Where are you doing that through? Yeah, I'm not hoping to see 2,700. I mean, if it drops, it drops. But I'm not hoping to see Bitcoin go down at all. But yeah, let's just take a peek at Bitcoin today. There is the B to the T to the C. So I've had that line at 29,740. We broke below it. Not looking good. Here's your daily. So, today you had a pretty significant break of it. And now you look at this chart and you got to ask yourself, well, where the heck's it going to go? What's your next logical target? It's usually the origin of the big move, which is somewhere down around 25,000. I mean, that's a heck of a move away from current price level. So I'm hoping we don't get down there. But remember, hope is that vile, disgusting four-letter word that I'm guessing you don't have Robinhood. No, Margaret. Actually, it's funny. I do have a Robinhood account. I just open up to see their functionality, but no, I would never use Robinhood. Robinhood isn't Robinhood is like trying to enter in any car race that you choose. NASCAR, Formula One, rally racing, but you have a 4-cylinder Honda Accord that's a jalopy. It works. It can get you around, but you got no bells and whistles. Hell, you probably don't have air conditioning in that thing. That's Robinhood. I wouldn't use Robinhood with a 10-foot pole. No siree, Bob. But to each their own, as long as it's working, whatever platform you use, if it's working for you, great. But remember, one of the reasons I have such a disdain for Robinhood is their sale of order flow. You have to understand that if you're using someone that sells their order flow, that means that you are being traded against by whoever purchased that order flow. So if let's say I'm Citadel and I buy Robinhood's order flow, I now can see all the orders coming through. And if I see all the little Robinhood minions trying to buy this stock because some guy on Wall Street Bets or Reddit said you need to load up on it, I can look at it, laugh, I can front run your trades, or I can jump up price and sell to you at a much higher price because, hell, I've convinced you to send market orders. So congrats on that one. So I do not trust anybody who sells order flow. Let's see, what else I got here? Tom says, this discussion made me look at my 2020 favorite FNGU. Past week has been brutal, Magnificent 7. Well, I mean, 1 week isn't bad, but let's look at FNGU. He loved them triple leverage. This was working great for you for a while, but yeah, in the last 3 days, we've gone from a high price of 228 to a low price today of 188. So a $40 drop in that FNGU, again, which is triple leveraged FANG stocks. But, this looks bad, but I don't see you complaining too much about it going from $37 up to 200 plus since the beginning of the year. So, yeah, dangerous one. I don't trade them. I don't trade this one at all. I feel like a little too risky for me. Although, if you're trading it, Tom, look where we're at now. Go right back down to the origin of this move. You got a hammer formation right at the bottom. Oh, man, that's starting to look a little tasty. It's interesting. It's a conflicting sign to what I'm thinking. If this is triple leverage ETF for the FANG stocks, it's basically saying it looks like there's going to be a rip up here. We had the same basic candle happen right here on the 11th of July and another one actually the day before it on the 10th of July. But you have a hammer formation right into demand zone after an aggressive fall. My guess is on high volume, which I'll show you here right now. The higher volume, but nothing really that dramatic. So, this makes me want to look bullish at the FANG stocks, but I'm also looking bearish on the triple Qs overall. So, well, I have a trade somewhere, I guess. What do we got? TD will spend time with you and help you learn their Thinkorswim platform. Yeah. There's other, there's YouTube videos and stuff you can always go and look at to find instruction on specific things with the Thinkorswim platform. But it's a lot, right? So if you're especially, and Jeff, I get that you're probably more experienced, but for those who are new, I would not put somebody that's brand new in Thinkorswim. I would say you need to start off on E-Trade and understand just the basic level 1 entry platform and say, all right, here, I understand every step, limits, market orders, here's how orders work, bid in the ask. I got to know all that basic stuff before I start worrying about the complexity of what Thinkorswim does. Let's see. Tom says, I'm still trying to get Elon to buy Hood and roll it into X. Don't rule it out. Tell you what, he's, the announcement was, obviously you guys know, he's changing the Twitter bird will no longer be a Twitter bird. It's just going to be an X, which I think is an interesting move. I mean, look at the brand equity that you have in that symbol, right? That is a world famous, people are everywhere in the world know that Twitter bird, that little Twitter icon. It spent time and money to get that kind of recognition. And Elon's like, scrap it, move on, brand X. But it will be interesting to see over the next 6 months or so what Elon does with some sort of financial network. I believe that to get Twitter where he wants it to be, which is financial services company, I think he needs to buy something outright. And you're probably right, Tom. I think that's probably the most logical target at this point would be Robinhood. Now, of course, it could be anything else. Knowing Elon, he could start it from scratch, but that's just too much legwork for him to do at this time. Just buy someone who's already got some technology, and then you can improve on that going forward. So Robinhood becomes a pretty attractive one. Let's see. I'm trailing profits, but it'll be nice if we can achieve my level. Yeah, well, good. Keep trailing it. You know, trend is your friend to the bend at the end, and we just had that big break on Bitcoin, so the probability is higher that's going to continue to drift down. Let's see. TradeStation also has free weekly online classes. Any complex platform should, right? Just to make their customers better, add that stickiness, and make you feel more comfortable with the platform. Comment from Les here, which I will get to. Thank you, Les, for all the comments that you usually leave. I appreciate those. He says, a comment from last week about banks. I was a depositor at Wachovia. As you guys might remember, I was talking about how Wachovia in 2008, they went into receivership just like First Republic and Signature Bank, etc. He says, I noticed no problems with the deposits, checks, or anything else. The transition went perfectly fine for me, except having to buy new checks with Wells Fargo's name. Right, and my guess is, Les, you had under $250,000. If you had over $250,000, there may have been an issue. But what happened in that crisis was they were bailed out by the FDIC. The Federal Reserve came to the rescue and said, okay, we'll say it's really similar to what we just had several months ago, where the depositors at First Republic didn't really feel anything. There was no shock to the system. Now, some, if you had a certain amount, like let's say you had $300,000, if you went to pull that out right away, they may have said, you can't pull that out right now. That's what I was referencing, where they were censoring transactions and limiting the amount you could withdraw. So, your business as usual, probably not going to be impacted because you're not taking everything out at once. You're not a run on the bank, right? That's what they were worried about, is the run on the bank, which somebody like yourself would say, you said I was under 250,000 and I still am. I'm hoping let's get over 250. Let's get over 250 in there. But if you were a Wachovia or a Washington Mutual customer, let's say you had $3 million in there, you said, hey, I want to transfer that out right now to another bank. They might have been like, hold on, not right now, just wait a second. And everything was fine, I believe, with Wachovia and Washington Mutual, because the banks got bailed out. Right, they were too big to fail. And that's the same thing that happened with Signature and First Republic. First Republic depositors didn't have to worry. Now, there may have been slight hiccups, slight delays. They're like, hold on a second, your money's safe, but you got to wait a couple days to get it. That's what I was referencing, where they're basically saying, let's hold on, you can't get your money right now. Where that's my argument for Bitcoin. If I've got $1 million worth of Bitcoin, I can move it right now, and no one can say, oh, sorry, it's not there right now. It's somewhere else. Right? That's the big difference that digital assets bring to the table, which is why I'm such a big advocate. All right, don't worry. There's nobody like crying or screaming outside. It's they're sanding the facade of the home next door. All right, let's see. So Les sent this one in as well. He said, could you review with us again the rules of gap trading? When does an inside gap fill or the outside gap, runaway gaps, exhaustion gaps? I'll be honest. I don't sound rude. I don't really care. I have a very simple way that I look at gaps, and some people want to be much more, I guess, detail-oriented about it. I don't think we need to be that obsessed with gaps. My rule number one with gaps is gaps tend to fill. Right? The vast majority of gaps over time will fill. Sure, there's some gaps on Amazon that go back into the early 90s or mid-90s to late 90s that may never fill, right? Just it was a startup at that point, so probably not going to fill. However, I look at them as a magnet to price. Now, some might be new and wondering, what's he talking about with inside gap, runaway gap, and all that stuff. Let me bring up a screen here and see if I can do a little bit of artwork for you. Let's see, which slide is that. We'll put it right here, and then I'll get to Jeff's question. So let me change this layout for you real quick. Hold on a second. Okay, so here is, so breakaway and runaway gaps, in my opinion, are pretty much the same thing. A gap like that is typically where you have, here, I'm going to do break. And I know some of you guys are going to correct me, but I try to keep things as simple as possible. So if I have a breakaway, I'm writing on the screen, break away. And for those that criticize my penmanship, you try writing with a mouse. Break away, run away. Okay, so those are your two gaps to look at right here. Typically, what you're looking at is, you should be seeing writing on there soon. Hopefully it shows up there. So typically with a breakaway run a gap, you have something that's been on a trend, and all of a sudden it gaps up and then keeps on trading. So, you can have multiple breakaways. And the key is, how do you trade this? I have witnessed from a trader I knew a long time ago, one of the most horrific losses that I've ever seen someone with my own two eyes take. And what he did is, I'll draw it on the screen. What he did is he expected the gap to fill. And I do expect gaps to fill. I just don't think they're going to fill immediately. So let's say you got price chart moving up like this, right? So here's price moving up, and all of a sudden it opened up here. So let's say this was, I don't know, $50, and this is now 80. A monster gap, right? Huge, $30 gap. Like, holy cow, that's a giant gap. If you were short that one, you're in trouble. So what he did is that day, it opened at 80, and I expect this gap to fill, but it doesn't have to. So I have to put rules around it, because what this clown did, I look at him now and I think he is a clown trader. I think some of the things he did was just totally stupid. He's a real gambler. He started shorting tens of thousands of shares of this stock. So he just went short, because in his mind, it's got to fill. So what it did is it rallied up that day. Next day, gaps up to 100. Next day, kept on going. It just kept gapping higher and higher and higher until ultimately they liquidated his account. He lost $800,000. $800,000 because he kept shorting something that was incredibly strong. And you guys know my mantras. You probably get sick of hearing these stupid mantras on the show, but they're there for a reason. The trend is your friend until the bend at the end. And on this example, there was no bend. It never went down. It was just constantly gapping higher and higher and higher, and this guy decided it's got to come down now. Well, because he didn't have any rules on this one, he lost it all, and you know what? He deserved to lose it all, just because. Oh, yeah, ATVI. So what could he have done? So let's say, sorry, it keeps going back like this. So let's say that same situation happened, and now it gaps up here, and it's back to $80. All right, so let's say this is the $80 line. What I would do is I would literally put a line right there, and it's okay. I'm not going to short it right now. I need to let price start to fill the gap, right? I have to let it come down. And this is what I was doing with the Nasdaq shooting star on the weekly, this morning. So let's say that this line right here, I'm going to just put, we'll just go 79.50, right? That's this line right here. So if it doesn't get down below 79.50, well, it's not closing the gap. I'm not worried. All I'm saying is I'm going to leave a little bit on the table that if it does start to roll over and now breaks down below it, now I can start to short. And of course, I have to have a stop loss in here as well, right? And you got to know when something gaps up like $30 per share, like a 35, 40% gap, you probably want to be very careful about shorting it, because some news is out there, something's driving that thing to the upside. So this is certainly a dramatic example. Yeah, Simon, trust me, I was pretty shocked at that as well. And the crazy part was he was managing other people's money, so it wasn't even his. That's what made it. That's why he's a clown, in my opinion. Should never do that with other people's cash. You want to take crazy chances with your own money, do it. But this was just an example of no rules in place. So to the point that Les was asking about, breakaway gap, well, this started off right here as a breakaway gap because it was in a trend, it jumped up. Well, what do? Well, my rules are simple. Let it gap, wait for it to pause for a minute. So typically what I do on a gap like this, 15 minutes. I wait 15 minutes. And what I'll do is I'll let it form 3 candles. So let's say, for example, on this day, and I apologize, I know my drawings are really bad, but now let's say I've got 3 candles that have formed. I've got a nice little green candle. This is supposed to be green, but I can't change the colors. There's green. I've got another green here. And I have a red. All right, so I waited 15 minutes. These are 5-minute candles here. So I've got 3 of them there. basically what I would do is I'd go like this. I now just wrap lines around that zone. It's okay. Oh, I didn't know I could zoom in like that. That was pretty cool. Wow. Shocking. Who knows? Who knew I could do all this stuff? I love that. This is my rule, Les. And I basically just completely truncated every strategy, whether that's inside gap, outside gap, breakaway gap, runaway gap, you name it. My rules are the same. Now, of course, there's psychology behind each one of these formations. When you have an example like I was showing you earlier where a stock goes from 50 to 80, I mean, obviously that is a massive sentiment change. But if I have something that gaps up 35 cents overnight, not a big sentiment change. So all these gaps are going to be driven by a change between one time frame and another. Typically, it's an overnight position. You don't get too many gaps in futures markets unless you have the weekend rollover or when they do the reset each night. But that's my basic rule. Now, on an inside day, for me, an inside day and an outside day, for those that may not know what those are, let me take this. And by the way, if there's any questions, just ask me and I will type them in. Anytime people think the market has to do something is when they're, yep, exactly. When you say the market has to do this, that's usually when you get your butt handed to you. No, I'm not drinking no whiskey on a Monday, day trader. Let's see, Nvidia gapped up 80 points on 525 and kept going. Yeah, and that's the thing. There's a reason why these things gap up typically. So let me show you, an example of an inside gap. So let's say, an outside gap. So let's say that this day ends right here at $50 and it gaps up here. You have an outside gap. Let's say that this is the trading range. So this is 1 day. Right here, you have 2 days. Right, just so you can see like ranges. And there's 3 day. So this right here, if it opened up right here, this would be an outside gap because it's outside of the range. So here's the range for this stock this day. Anything in here would be an inside gap. Anything outside, either there or there, would be an outside gap. So what? Easy. I still have to do the same rules. I still wait 15 minutes. If it's an outside gap, I'm typically expecting it to come back and fill that gap. If it doesn't, fine. Because remember, what I've done is I've taken 3 candles, I'm waiting 15 minutes. Let's say those 3 candles look like this. Okay, great. I wait 15 minutes. And even though I think it's going to fill this gap and come down, I can still make the same trade to the upside. And say, all right, if it breaks out of that 15-minute range, I'm going to start to take a long trade, betting that this is going to keep on going. It's, to me, at least in my opinion, and this is very much my opinion, so don't think that this is industry standard, is within 15 minutes of the market open, you get that a bulk of the order flow has been processed. A bulk of the institutions have done what they need to do, and you start to get a clearer direction. So once that's done, then things calm down and trends form. And I know many of you have watched where reversals happen in that right at the first 15, it seems like, boom, they just start to reverse. So what I've done here is I've taken someone's outside day and said, look, it's a long trade or a short trade. I don't really care. I can't have the opinion that, it has to fill the gap. If it keeps going like Lori was talking about with Nvidia, great, because I can still go long that trade. It's about being flexible. I think, what was it, Bruce Lee? You want to be the water in the cup. Right? You just go with what the markets give you. And let's look at the Nvidia just because I have not looked at this, but since you brought that one up, Laura, it's a good NVDA. You're going back to 525. You have it right here as well. Is this the one you're talking about? Yeah. You had a gap. Never filled this gap. Came in a couple cents into it and just has been running ever since. You notice back here as well. Right? You had an outside gap right here on February 23rd. Gapped up, filled a little bit, and just kept on going. I'll just keep scrolling back here and you'll see a lot of them. Here's one where it was actually trending down. You had this, call it a breakaway gap, if you will, a gap down and kept on selling off. It didn't come back in for, took 4 days for it to start to even remotely come back into the gap, but the trend was your friend in this case as well. So, I just try to keep it as simple as possible and not make all these proprietary rules for each individual formation. I'm trying to use a universal set of rules, and this is just why for me, trying to keep things as simple as possible, a universal set of rules that makes it simple for all the formations, whether I'm doing shooting stars, hammers, haramis, engulfings, inside days, outside days, breakaway, runaway gaps. Try to make it as simple as possible. Gaps are filled, which are closer to price, only on a daily chart. I mean, obviously, I'm looking for most of mine on the daily chart because that's where I tend to get the gaps for equities. Futures, you don't really get too many. Craigwell always says that the only thing that he can control is his lot size, so wait. Yeah, your lot size and the ability to make that decision at all. And, you know, you look at somebody with Craig Wild's experience and time on the trading floor, you know, you have to appreciate someone who's traded for 40 years and still continues to make a living doing it. And that's the utmost respect. And again, I know I vent, but sometimes I get so sick of watching these, 16, 17, 18-year-old kids on TikTok that have like 50 million followers and they don't have a clue what they're doing. And everybody thinks that they're just absolute geniuses. You know who should have 50 million followers? Greg Wild, Michael Young, right? Those guys, Marty Dim, those guys should have hundreds of millions of followers because they're really good, consistent at what they do. Just plug along and don't take big risks. And you do take a big risk, the odds have to be in your favor and you're probably scaling into something. So rules and keeping things real simple. Most of the yahoos on social media that have all the followers don't trade. Blows my mind. One of my rules is not trade the first hour of trading. Okay. Personally, that's too much for me, right? I don't like getting up anyway, so I'd rather just miss the mornings altogether. But sometimes there's really good opportunities. Today I was like, here we go. I thought I was going to have a screamer of a down day. And it got me right in, did another 5 minutes down, and then took me out. So, they certainly happen. I'm Ronaldinho in here. Yeah, that's a great compliment. He's one of my favorite players, man. That guy's just a magician with his feet. So anyway, Les, I hope that helped a little bit with regards to breakaway, runaway. I know I didn't address each of them individually because I don't care. But in hindsight, you could put a name on any gap formation or any candlestick formation. In my mind, the key is whatever that you're seeing on that chart, how are you trading it? Right? How do you perceive that information? And you guys can bring up any chart at any time. I'm always happy to look at whatever you guys want to look at. I don't know. What's one that I have not looked at in a long time? How about U.S. Steel? I haven't looked at U.S. Steel in forever. All right. So let's go back to U.S. Steel, see what's going on with U.S. Steel. Right? Here's a great example. Great example. Oh, I love it. This is perfect. So if we look at this price chart right here, you had a big run up. Everything was looking great on this. You're like, okay, cool, looks good. Trend's your friend, and all of a sudden, the next candle, a monster red one. And you might have anticipated that because you had a shooting star on July 3rd. Anyway, it gaps down. Now, if you did the knee-jerk reaction thing that a lot of people do, they're going to buy this immediately, go long U.S. Steel because it gapped down. They think it's going to fill the gap, and that day you'd have been smoked. You just got crushed because it went down all day long, close of the deadline, and then gap down the next day. Right? This is why you don't jump into things until you get confirmation. So, I could go on and on and on, but that hopefully Les gave you a little clarity into it. It's not for me about the formation. It's just saying when you get the gap, you wrap your lines around it. You get a set period of time. For me, it's 15 minutes. For Lori, it's an hour. Cool. Whatever works for you and whatever lets you get your consistent results, or at least the best results that you can get. All right. Cool. Thanks, Les. And again, Les, all I'm encouraging you to do is just don't make things complicated. And so what happens when you think of, in your head, if I say breakaway gap, runaway gap, inside gap, outside gap, novice gap, expert gap, I now have 6 different things that my brain has to process. 6. You're like, what do I do? Instead, with what I just showed you, you can now just take that same basic strategy, and anytime you get a gap, you can wrap those same lines around it and not have to go, okay, wait, what do I do with the breakaway gap now? Do I put it here and then, I'm supposed to wait this and do? No, same thing. Make it real simple. Generally, my approach to most market stuff over the years has been just try to make it as simple as possible. Otherwise, your brain hurts, right? What you should be focusing on the most is your position size, the trade setup itself, and your stop loss, period. And once you're in it, now it's about trade management, right? Not, some crazy name that somebody gave for this pattern or some indicator, just your trade management. You need to send me a Chiefs shirt. Hey, you know what? I don't mind the Chiefs. Patrick Mahomes, at his current rate, he's a magician, and at some point, I think that he could be one of the greatest quarterbacks to ever play the game. But when my Niners play him again, which they will, we will win this time, and then I have to cheer for the Niners. Otherwise, I like watching Patrick Mahomes. He's good. AFC's got some great teams. I really like the Cincinnati Bengals, I think, are going to be one to watch. Anyway, we're not going to make this a sports show. Let's see. It also explains why a lot of gap rules don't seem to work. Well, and people keep changing them. Yes, for day trading, that's too much. 6. I don't day trade. I prefer swing trades. I agree. I prefer swing trades as well. Today was a day trade day for me. Tomorrow will be as well. I'll be up early. Now we'll talk about some of this. What time are we at? We're already at a long show. Jeff, I got more questions for you. Let me get to this one real quick because I have enough questions here to go for like 4 hours today now that I'm realizing it, because as you know, I get wordy and verbose sometimes. But let's talk about this one real quick. So Jason says, thoughts on GE earnings tomorrow? Yes, I do know GE's earnings come out tomorrow. That's before market open. I hate to say it, I'm a fan. I'm a fan of GE. Hard to say this. I was a GE holder for a long time, and they spun off that railroad company, and then I sold all my shares and had a nice profit in it. But if you look at GE, it is one of those charts that a lot of you are going to scratch your head and go, I'm sorry, this isn't GE. This is like Apple, right? This is some major tech stock. I mean, what the hell is going on with GE? I mean, this year, from the middle of last year, it's gone from a low price of $46.54 to $110. I mean, and right now, it just looks so unbelievably strong. You're like, what is going on? Because my dishwasher and refrigerator suck from GE. Anyway, what is it? Well, it's because GE is becoming a pure defense play. And what it means is they're spinning off the other business models. They're splitting into 3 different businesses, essentially. And then GE itself will be focusing on aerospace, which is a huge market now, especially with all that's going on with Elon Musk and Blue Origin and SpaceX and all that stuff. Big engines, big money, aircraft, supersonic flight. So they're now going to basically make a pure defense play by spinning off all the pieces of GE and keeping GE itself, that ticker symbol, is just the aerospace. Now, there's also other companies that have been spun off already from this. They did this one, I don't remember the date. I think it was in January. It's GE Healthcare, so GEHC. So anything to do with healthcare products and machines was spun off. Yeah, this was spun off, looks like December of last year. And this, if you held GE shares, you were given some of GEHC. And it's the same thing for the other company, which is going to be called Vernova, and that's going to be GE Energy. So you're going to have a healthcare company, which is GEHC, General Electric Healthcare. You're going to have an energy company, which is called Vernova, which is I believe it's supposed to happen maybe late this year, early next year, but I think it's more like 2024. And then you have the GE shares. So if you own GE shares now, you're going to get that energy spinoff. So that's part of the excitement of it, is people are going to hold that because they'll now get some of this new company, Vernova. And then, you look at what does that do to GE? Well, GE is not losing money on its defense stuff, right? They're looking better and better and better. And now you look here. Let's go to GE real quick. So while they have missed a bit, you can see back here in October of last year, they were expected to make 37 cents, and they reported 27. So they missed there, but it got better. It jumped significantly. They expected $1.15, and now they made $1.24. Why? Because they spun off some market segments, some pieces that weren't that profitable. This might have been some of the GE healthcare stuff losing money on. I don't know exactly what it is, but their numbers started to look pretty good. Now, all of a sudden, like everybody else, they lowered their forecast. They beat earnings at the last earnings call. What I did notice was 2022. So in 2022, their revenue dropped 3%, but their earnings increased 53%. Now, I know we've got some accountants in the room. You know that this is a conundrum, because revenue is the money you bring from all of the things that you sell as a company, and that declined 3%. So GE sold technically 3% less money coming in, but their earnings increased 53%. So either they have spun out those losing operations or just dumped those businesses which were causing them to go down, a la Jack Welch, or they've done just incredible cost-cutting measures internally. Who knows? Maybe it's just AI implementation going on, but it's crazy to see revenue's been declining at 0.3%, but earnings overall, after you take in all the operations expenses, is actually up 53%. Usually it's the opposite way, right? You see revenue growing, but earnings are declining because they're spending so much money on R&D and more employees and expansion. So really was incredible to see their earnings jump. Yeah, that's a lot of cost-cutting, Margaret. It's got to be something else. You can't increase earnings that much just with cost-cutting. I mean, I remember stories of Jack Welch going through and it could be write-offs as well, John. That's true. And I'm not too much of a fundamental analyst to look in the balance sheet and see all that stuff. But I was just looking at the 2022 numbers. I'm like, wow, that's pretty crazy. Lower executive salaries. Good luck with that. Those guys don't make less money. Anyway, thoughts on tomorrow. So I will bring up the earnings calendar here so we can see what's cooking for tomorrow. I'm not going to touch it. I'm not going to trade GE on earnings. I haven't had GE for a couple of years now. No real interest. But they will be doing before market opens. Let me read you the BMO ones. That's Verizon, General Electric, General Motors coming out before market open, Archer Daniel Midland. You got 3M. You have Next Era Energy, and that's pretty much it for the big, and Biogen. Those are all BMO. AMC, would not the garbage cinema company that you shouldn't go and buy, but we have popcorn trades of the day. I love using the graphic. Thank you, Tim, for that. But our popcorn trades of the day, you've got one monster. Let's call it two. I mean, together they got a $4 trillion market cap. So what are we looking at? Well, number one's going to be Microsoft after market close. You also have Alphabet reporting earnings after market close. You have Visa. You've got Snapchat, Texas Instruments, and Waste Management after market close. So some really big names reporting earnings after market tomorrow. So that'll be stuff that you need to pay attention to. As far as economic announcements, most of the other countries around the world posted pretty bad manufacturing and services numbers. I mean, we were focusing on that as in our Monday morning must knows. It's kind of, that'll tell you how the world is looking at manufacturing. Wasn't really good, but then you get to most countries missed. So notice here the UK missed on, I'll highlight it here in blue or gray, whatever it is. They missed on services and manufacturing numbers. Same thing here for the European Union. They missed on their numbers, worse than expected. So really ugliness from all countries until we get to the United States. Now, you notice on our services numbers, they're expecting it to go down slightly. We went down more, so that's bad. But this one here is actually pretty good. Manufacturing was expected to decline. It actually increased, yet we're still below that 50 line. So, that's nice to see it pop back up. We're still in a negative, pessimistic manufacturing environment. But it was certainly a beat, and I think that's a good sign because, as I pointed out, it's a big percentage of GDP. Now, here's what's cooking for tomorrow. You can see here we have, for the U.S. markets, HPI data, the Case-Shiller S&P Composite 20 Home Price Index, which is going to forecast further price declines in homes across the United States. You have CB Consumer Confidence, Richmond Manufacturing Index, and then for Australia, you have a little bit of Consumer Price Index numbers as well. And let me show you the Case-Shiller Composite 20 Home Price Index just so you can see. Notice this may not be casting any real pain in the market yet, but it could, because you're seeing year-over-year price contraction of homes. That's anything down below that zero line means that prices are actually declining, and this is year-over-year stuff. So not good, especially for people who bought in the last 6 months, 8 months, maybe even a year. All right, if you bought in the last year, you're probably looking at your house price under what you paid for it, and hopefully you didn't lock in at 7%, because that's just double insult, right? You got a 7% mortgage, and all of a sudden the value of your home's declining. You know what that leads to? The nasty F word, foreclosures. So hopefully we see this tick back up a little bit for the sake of our markets. If it continues to grow below zero, you give yourself 6 months, 8 months, maybe a year down the road, that could have profound effects, especially if interest rates continue to rise. Anyway, that's what we got cooking for. Earnings calendar for tomorrow, economic calendar for tomorrow, and that will do it. For tomorrow's show, I did get a question about the UPS strike. So what I'll do is I'll start off with that one tomorrow. Oh, yeah, house flippers are hurting. Oh, man. Yeah, bad. It'll still work for a little while. I noticed that there's some homes in my neighborhood that I think that they're in a flip. But boy, you're getting to the tail end of it, and that's the problem with home flippers. It's great way to make some money. If you got a good team with you, if you have a crew that you are like a machine, you can flip houses and make some great money. But when things turn and those sellers or buyers dry up a little bit, you might be holding something through a monster loss. And one bad project could eat a lot of the gains you may have had on 3 or 4 different projects. So let's talk about the UPS strike, what that might mean for our economy. That's coming up August 1st. That's the deadline that the union has put on this one. So we'll see what the probability of that happening is and what the devastation may be if it's anything like the previous UPS strike that we had several years ago. So that will do it for today's show. Again, if you guys have questions, you can always email me at TraderMerlin@gmail.com. For those that I didn't get to your questions today, I meant to make this a Q&A show, so I will give a shout out to Jason and Jeff and Les for your questions that came through. But I know I've got some I didn't get to. My apologies. I'll have to do more Q&A shows, but hope you guys enjoyed that one. Again, if you have any comments, put them down below YouTube videos. That gets priority. I take the YouTube video comments and throw them into the PowerPoint slides here so I can get them all rocking. Anyway, have fun. Watch out for your Microsoft trade after market close tomorrow, and I will see you guys on our Tuesday show. Take care, everybody. Oh, and by the way, Bill Addis will be our guest on Wednesday. Right after that FOMC announcement, good old Bill comes on the program talking about what is going on with the Fed. I'll see you guys tomorrow. Take care.